Hello, everyone, and welcome. Thank you for joining Witham today. We have a great presentation in store for you all. Before we begin, I have just a few housekeeping items to cover. First, you will be on mute during the presentation. However, at the bottom of the toolbar, you will see a chat box. We encourage you to ask questions during the session, which our guest speaker is happy to answer. This session will also be recorded for future reference, and a link to it will be provided to all attendees. Feel free to share additional thoughts or input after the webinar has wrapped up as well, as your feedback is greatly appreciated. And with that said, I am going to turn it over to today's moderator, Jim Hannon, partner and practice leader of Witham's Manufacturing, Distribution, and Logistics Group.
Thank you, Alexis, and good afternoon to those of you on the East Coast, and good morning to the rest of the nation here. Thanks so much for joining us today as we are in first quarter earnings season. And just a subtle reminder from my tax partners to please file your income taxes on time next week, okay? But we have the pleasure of many manufacturing and supply chain company leaders joining us today. And we certainly recognize their efforts in sustaining operations, pivoting to address a number of challenges and headwinds that have surfaced over the past few years. You know, just a couple of minor items: a pandemic, supply chain disruptions, trade wars, labor shortages, inflation, and logistics. And we certainly applaud their efforts for all that you do. It's a huge sector of our economy and certainly supports a number of our families. So thank you on behalf of our firm and a grateful nation for all you do to keep the plant operating and keeping the shelves full. It's been a couple of years since we had Chad Moutray as a presenter on behalf of our firm. He is the chief economist for the National Association of Manufacturers, where he serves as their economic forecaster and spokesperson on those issues. And you see him quite a bit in the mainstream press and networks to weigh in on everything manufacturing. Prior to joining the NAM, Chad was the chief economist and director of economic research for the US SBA, representing the interests of many small entrepreneurial businesses in the nation, and the former dean of business at Robert Morris University. He holds a PhD in economics from Southern Illinois University. At Carbondale, go Salukis. A number of us on the East Coast, Chad, know the Salukis through one of their alums, Walt Clyde Frazier. And I will tell our audience now that Chad is even cooler than Clyde Frazier. He also received a bachelor's and master's degree in economics from Eastern Illinois University. From an editorial perspective, if you don't read Chad's weekly Monday economic report through the NAM, you're really missing out on a lot of good economic data. He does a great job filtering through that data and presents it in an easy to follow format. And it's been needless to say, a busy past few weeks on economic data, Fed strategies, and markets. So live from our nation's capital, I'll turn it over to Dr. Chad Moutray, and he'll tell us, what do we need to know, Chad? Thanks.
So hopefully, let's see if this works this time. There we go. Can you see that?
We can now. Great.
Hey, good job. Good. So I can't see you, but you can see me, which is great. So anyway, thank you, Jim. I don't know if I've been called cool before, so I appreciate that. If you, again, to your comment about the Monday economic report, feel free to email me. My contact will be at the end here if you're interested in getting that. If you're an NAM member, you already do. But I also post it up on Twitter and LinkedIn, so you can follow me there as well. You can see that I'm chief economist at the NAM, but also straddle over into the Manufacturing Institute. So lots of workforce topics, and we're doing a lot on that in that space. So before I get too far into the slides here, let me kind of set this up this way, right? The reality is that there's a lot of conflicting data points out there in the data right now. I mean, just if you look just at the last week, for instance, we had record levels of manufacturing construction data, right? That led to a really great article over the weekend about manufacturing coming back in the Wall Street Journal. So I kind of have you look at that if you haven't. Certainly, there are conversations about, are we in a recession? Are we going into a recession? Manufacturing certainly has been stalling at a minimum, but pulling back in a lot of sentiment surveys. So that certainly has kind of expedited that conversation. We've had worries about a banking crisis in the last month, and that certainly could affect access to capital, especially for some small and medium-sized members. But at the same time, the number one issue, you'll hear me say this in a second, is workforce, right? Overall, the labor force continues to be solid, and there's some signs of green shoots out there as it relates to some economic factors, especially abroad. So again, I'm an economist, so you'd expect me to say on the one hand, on the other hand, and so you're going to see a little bit of that kind of in spades here. So this is the NEM Manufacturers Outlook Survey. We've been doing it for a little bit more than 25 years. You can see that at any given time, about 3/4 of our members are positive about their company's outlook. And that's essentially where we were in the first quarter survey that we released in the last couple of weeks, right? You can see certainly the recessions up here that we've had over that time period. Spoiler alert, I don't have a gray shading for the last year, right? So I don't think we have been in a recession, nor are we in a recession right now. But we certainly have seen quite a bit of turmoil, again, as Jim noted, starting with the pandemic and moving forward. We have, roughly 75% of our members positive about their company's outlook. That was an improvement from where we were in the fourth quarter, where we had 69%. But you can see that this time last year, we had 89% of our members positive. And what's happened really in that intervening year is everything that Jim mentioned kind of in the setup there, right? We had the Russian invasion of Ukraine in February of last year. That certainly continues to be something that is challenging, especially Europe. And energy and food markets. You had supply chain issues, you had inflationary issues, worries about just a downturn in general, which is this constant drip of worries about a recession. And so that really has led us to where we are today. I mean, there's a little bit more resilience there than I suspect sometimes we kind of give it credit for. We still have 3/4 of our members positive, right? So that certainly is a sign that at least on in terms of that headline number, there's some more positives there than I think sometimes gets caught up in the media. The media is determined to say that manufacturing is in a recession, right? And I have largely avoided that word. You've seen me use the word in my Monday report that manufacturing has been challenged, or as I referred in this week's Monday report, overall hiring has stalled, right? But in part of my hesitance to say we're in a recession is this chart, right? When we go out and ask our members about the next 12 months, you can see that those expectations are not negative, right? In fact, overall sales and production growth expected to grow modestly. You have very modest growth in capital spending and hiring over the next year, right? So you still have some positive growth expected. Perhaps that's cautious optimism, but still optimism for growth over the coming months. We've seen that number fall, right? So there's been quite a bit of deceleration there. If you go back again, this point last year, sales were expected to grow just over 6%. We're certainly about half of that now. But so that's essentially where we are. The other comment that I'll make, and I'll show you a little bit more when I get to the factory orders data, is that when I'm traveling around and meeting with manufacturing members, the one thing that I hear consistently is just how much the manufacturing has grown over the last couple of years. So to the extent that we're pulling back now, we're pulling back from a really strong base, right? And so that also, I think, helps kind of at least mitigate some of that damage, and that we are on a year-over-year basis, oftentimes still seeing positive growth, which is encouraging. The number one issue in the Outlook survey that we did in the first quarter was workforce. That was the number one issue in the fourth quarter as well, and it's perennially towards the top of the list. But everywhere I go, small, medium, and large, every sector is telling me that they're having trouble finding workers, right? The labor market is still very tight. We'll talk a little bit about that towards the end of the presentation here. That certainly is a challenge that has been even more exacerbated because we're having a lot of what I would call non-traditional players kind of competing against us, right? So a lot of people in the service sector, really rapid growth in wages there as well. So everyone really is scrambling for the same workers, and that's making that much more challenging. You still have raw materials and supply chain towards the top of the list. Those have been, or were at one point last year, the #1 issue. They've fallen down the list, although you still have a pretty sizable percentage that are saying those are big challenges. Largely, we've seen some moderation, both in terms of inflation as well as some of those supply chain issues. But as seen here, even with that moderation, there's still challenges for a lot of folks. I mean, and you see that today we actually got, it was mentioned earlier that I used to be chief economist at the SBA. The National Federation of Independent Business released their monthly survey for March. The #1 issue was inflation, but right behind it was workforce. So we're very closely aligned with where some of the small businesses are in this country. I've asked this question for the last few quarters, really, probably the last year and a half. Well, when do you expect supply chain issues will get better, right? So you can see that as of the first quarter, roughly 21% of our members say that they're already better, right? And if you take that forward to the end of this year, 61%. If you take it to the end of next year, it's 83%. So that's what the survey says. And I suspect that supply chain means a lot of things to different people. But the reality is that we've also seen some progress on the supply chain front. When I'm talking to members themselves, they say that things have stabilized. If you're looking at freight costs, if you're looking at delivery times, if you're looking at where inventories have been really over the last year, those are moving in the right direction. Maybe moving in the right direction for the wrong reason, right? That the global economy has slowed and that has allowed some of these bottlenecks to catch up. But there is certainly some progress there. I mean, freight costs aren't necessarily where they were pre-pandemic, but they're close, right, to where they were before those bottlenecks really kind of came to a head in the last year or so. And so that certainly is some progress, but there also are some structural issues here, right? If your issue on the supply chain side is you don't have workers or your suppliers don't have workers, that's not something that has gone away yet. And so that certainly kind of plays into that. And so this is where it is an issue, it's still a pretty big issue for some of our members, even though in my view, you've seen some trends in the right direction. The other kind of headline that came up, Jim, yes.
Chad, just a question popped up in the box from our audience, and I'll paraphrase it.
Sure.
Our last slide, obviously a big concern is raw material prices.
Yeah.
A drop in overall demand has helped bring prices down, but have they bottomed out? I guess is the question, and then there's another one after that.
The price? No. The prices have decelerated pretty strongly, but I wouldn't say that they've bottomed out. They're still pretty elevated.
Okay, and then how have wholesale companies and manufacturers addressed the risks associated with supply chain disruptions and activities?
That's a great question as well. I mean, I think the one thing that you'll see a little bit later on, I have inventories as one of our downside risks. The reality is a lot of companies, especially small and medium-sized companies, the last thing they want to do is shut down production. And so they're keeping a little bit more inventory on hand, right? I spoke to a small manufacturer in Texas that they actually had to acquire some additional storage space because they were keeping more raw materials, some key inputs to the production process on hand, a lot more than they used to pre-pandemic. Just because, again, the last thing you want to do is shut down production. So we've seen a little bit of hedging when it comes to inventories on the part, especially manufacturers. You've also seen manufacturers be much smarter about their procurement in terms of doubling down on key suppliers, maybe eliminating or kind of reducing some redundancies there in terms of some suppliers as well. So, think of the chip crisis. I've talked to a lot of folks in the auto sector, for instance, where there was a lot of issues with chips that affected the auto sector, a year or so ago. And those cars pre-pandemic would have required hundreds of chips, right? And they've reduced the number of chips that are in cars or trucks pretty significantly through some re-engineering over the last year, which has allowed them to navigate kind of moving forward and not have to shut down production and not have to rely so much on kind of this vast array of chips in the process. So I think companies have been a little smarter about the procurement, a little smarter with using data and digitization, but also hedging quite a bit when it comes to inventories and how much they're keeping on hand. That helps, Jim.
Great, thank you.
So the other headline that came out of this was this one, which is, do you think the U.S. will go into recession this year? So we've been trying to talk ourselves into a recession for the last year, and so this is the recession that continues to be forecast that hasn't come yet. And to be fair to this question, it was 62% who said this in the fourth quarter. That slipped a little bit. There was a lot of conversation about the increased chance of a soft landing before the banking crisis. And I actually would count myself in that camp, that I think a soft landing is more possible than we kind of give it credit for. But this question actually was asked before the banking crisis. And so I suspect if I were to ask it again, that number might go up a little bit. So a little bit of a mixed picture here in terms of whether we're going into a recession or not, whether it's a mild recession, whether it's a soft landing. And that certainly was the conversation that a lot of folks were having. On that number one issue of workforce, you can see that there's a real economic impact here. If you don't have enough workers, right, you're not able to add that second shift, or you're not able to take on additional work. And you see here that 59% of our members say that not having enough workers has impacted their investment plans or expansion. That's a pretty significant percentage of our members that, really are saying workforce is having an impact. So moving away from the NAM survey to the ISM. So if you're thinking that manufacturing is in a recession, you're probably looking at this chart, right? Every sentiment survey pretty much looks like this, right? So you can see if you go back 12 months, manufacturing was still growing relatively solidly, but that certainly slipped over the course of the last year for all the reasons we talked about earlier. And more importantly, we've had 5 straight months where the PMI, the Purchasing Managers Index, was less than 50, which would suggest it was contracting. I do wonder to a certain extent whether this survey, as well as a lot of other surveys, were impacted by that negativity of the banking crisis. So you did see some pullbacks kind of across the board, not just in the US, but globally in March, which again, these are sentiment surveys. And so I think that probably that banking crisis probably impacted those numbers. Even aside from that, though, these numbers are clearly pulling back, right? We're seeing some stalling or much more challenged environment in the manufacturing sector, and that kind of plays itself out here. I guess if there's any red flag, it's that green line, and that is that new orders have declined for the last few months. And so that certainly is one that we would want to turn around moving forward. To the extent that inventories have played into these numbers, and I do think inventories have played into that. You did see some time shifting in terms of people trying to get around the West Coast port strike, or trying to time the markets a little bit so that they could kind of hedge their bets on supply chain issues. Companies are keeping more inventory on hand. You have seen inventories rise, and if you're keeping a lot of inventory on hand, you might not need to increase your orders as much. And so I think that also plays into this figure a little bit. That should improve if that's the reason. Moving into hard data, and we're going to get a new reading for March on Friday for this figure. You can see that we had a really challenging end of the year. So a lot of disappointment. November and December were kind of weak across the board, not just in manufacturing, but you had weaker retail sales, and certainly housing and a number of other sectors were pretty weak at the end of last year. We did see a rebound in January and February, although as you can see, February was just eking out a little bit of gain there. So we'll be looking when we get Friday's data for March, whether we continue to go back into negative territory, which seems probably likely, or whether we'll continue that rebound that we saw in January and February. The key part of that, though, is this one, right? Which is when you look at the overall manufacturing production, go back to a comment I made earlier, that to the extent that we're pulling back on activity, at least we're pulling back from a really strong base. So manufacturing production has declined around 2 to 3% over the last 10 months. But if you go back 10 months, we actually had the best manufacturing production and capacity utilization that we had seen since 2008, right? So it's clear that manufacturers have been really doing a lot to increase their overall capacity to try to meet the demand that was out there. And yes, we're pulling back, but again, we're pulling back from a pretty strong level. And so that kind of plays itself out in a number of ways, including the next two charts, which if you're looking for glimmers of hope, these next ones will certainly provide that for you. And so this one is one that comes out of the factory orders data. So this is showing you core capital goods spending and shipments. It's a proxy for capital spending in the economy. If you're looking for the actual report, as you see in the note down there, it's non-defense capital goods excluding aircraft, and those numbers have moved relatively kind of flat really over the last few months, but we're not far from an all-time high, right? So again, juxtapose that conversation with slowing manufacturing activity overall, with the notion that capital spending actually is pretty robust, right? Not far from an all-time high. And I actually talked to a lot of folks in this space who are selling into capital goods areas, and they're like, what recession, right? We're still seeing pretty robust demand. We still can't keep up with demand. And so this to me is very consistent with this notion that, manufacturers are very long-term focused in their thinking. They're, whatever happens in 2023, whether it's a mild recession, whether it's a soft landing, whatever, they still see us growing in 2024 and 2025. And manufacturers are putting things in place to kind of get us in a good position to grow moving forward. They're still doing a lot of intellectual property spending. They're investing in software. They're investing in new equipment, et cetera, and construction, which you'll see in the next chart. So I think those are all kind of reasons for us to be a little bit more optimistic than I suspect we are. And again, it kind of provides a little juxtaposition to some of the more negative numbers I showed you earlier. The other one is this one. This is what I told you earlier. Manufacturing construction spending has just soared over the last year, right? All-time high levels of construction spending. Now, to be fair, this one as well as the last one are nominal, right? But even if you were to adjust this for inflation, this is a pretty significant, sharp increase, up I think more than 50% year over year. And this to me is a sign that manufacturers are also doing some reshoring. So this is a sign that the article I told you about in the Wall Street Journal earlier was a sign that manufacturing is coming back, right? And so this is one of those proxies that I would look at to say that, yeah, it is coming back, right? So certainly the CHIPS and Science Act and the Inflation Reduction Act have kind of helped encourage some of that investment. But I think even outside of that, we were seeing companies looking at the U.S. in a different way, and this is a chart that really kind of puts a nice exclamation mark on that. And you've come back on the screen, Jim, so it looks like you have a question for me.
Yeah, a couple of them, Chad. Thank you. Excuse the interruption, but the last slide that you had on core capital goods, have those figures been adjusted for inflation?
They have not, right? So adjusted for inflation, they're probably they're still hitting, they're still up a lot, right? That we're way above pre-pandemic levels there, right? But probably not as steep of an incline as you're seeing here. But so they're still an encouraging number, but no, they're not. They're in nominal terms.
Okay, and are there any states showing more growth than others in the manufacturing sector?
Yeah, I mean, you certainly are seeing quite a bit of growth in, Texas and the Southeast, but don't discount some other larger states that are out there, right? You're still seeing a lot of growth in California and Illinois and the Midwest, where you've seen, some pretty sizable growth overall, right? So certainly you're seeing a lot in Texas. Texas tends to dominate. If you're looking at year-over-year growth in manufacturing employment, Texas is towards the top of the list, if it's not the top of the list right now. But again, you're also seeing, I think in the last month we had data, which was February, I think Missouri had the most growth. So it really is the Midwest, but also kind of that more traditional, the right to work states in the South, right? But and California has tended to fare well just because it's such a big state. And so therefore the numbers have been pretty favorable for that.
Okay, and I think you touched on this one too in your comments on the next slide, Chad, but we've seen some big announcements on breaking ground for domestic semiconductor production. When will we see the effects of the CHIPS Act rolling through?
Yeah, that's a great question. So those are breaking ground now, a number of announced ventures, some of them from some of our bigger members. That is expected to kind of, start impacting us in 2024 and 2025, right? As those start coming online, it takes a while to build those foundries and to be able to start production. And so that's probably more of a 2024 plus conversation. But the good news in this chart is it shows you that this is having a real impact, right? And so in overall non-residential construction spending is not this fascinating. But manufacturing certainly has been an outlier here with some pretty phenomenal growth, which has been nice.
Thank you. And today's Journal had an article on that too, on
Yeah.
non-residential construction.
Yeah.
Great. Thank you, Chad.
So turning to the global economy, much like the U.S., the global economy looks very similar, right? And so there's a lot of red on this chart. I'm actually going to be more positive than this chart might suggest. But so you see, this is the PMIs. This is from S&P Global, so very similar to ISM. Works the same. Any number over 50 is expansion. Any number under 50 is contraction. And you had a little bit of slippage in March, as I noted earlier. We had the top 3 markets in February in expansion, right? So Canada, Mexico, and China. A little slippage there, and you only had Mexico expanding in March. I still think that was the banking crisis. I think moving forward, I would expect to see some more blue up here when we get April and May data, especially for those top 3 markets. But I think overall, the reason why I'm a little bit more optimistic this year, you see China is 50 up here, so that was essentially neutral in March. It had been expanding in February. And I think that if you look at the overall Chinese market last year, it was really a conversation about the zero COVID policy, which was a pretty stupid policy, followed then by COVID, right? And so the conversation about China last year was one that was dominated by production stoppages, people not getting out and about because of COVID, et cetera. So far in 2023, though, now that zero COVID has been lifted, people are getting out and about. You've seen some pretty encouraging data in terms of retail sales, in terms of industrial production in China. And I think China is going to continue to be a nice upside surprise this year. They're expected, at least formally, their goal is to grow 5%. I think that they can get there. Last year, they grew just 3%, assuming you believe that data. Now, why do I spend so much time on China? Despite the kind of anti-China rhetoric that you see out there all the time, the reality is that we need China. We're still very interdependent with China as far as manufacturing and as far as the overall global economy. As goes China, so goes Asia, especially in the global and emerging markets. So we need a growing China if we're going to see more growth, more exports abroad. And so that to me, I actually think that the global economy is going to do a little bit better than we thought. Still weaker than desired, but a little bit better than we thought even 2 or 3 months ago. And I think China is a large part of why I'm a little bit more upbeat about the global economy. The other bigger conversation, obviously, is one about Ukraine, and that is going to continue to put a lot of uncertainty throughout all of Europe as it relates to energy costs, food costs, et cetera. Europe has so far avoided a recession largely because they had a relatively mild winter, but they're not out of the woods yet. Obviously, we still have the war lingering on. And if next winter is really cold, they're going to continue to draw down those energy supplies. So I think that Europe has to figure out what that energy solution is going to be long term if they're going to continue to be viable. But that's the larger global economy. So yes, lots of red on this chart. 8 of the top 10 markets that we sell into are contracting right now. But I think the trend line has been that these numbers are moving up a little bit, and hopefully we'll start seeing more blue in the coming months. The other conversation here is the dollar. So if I were to go back to last summer, early fall, you mentioned earnings season earlier, Jim. Everyone was complaining about the strength of the dollar last fall, right? Certainly we were seeing kind of these record levels of the dollar versus the yen. You were seeing parity in Europe against the dollar, et cetera. So a lot of that had to do with the Fed and just how hawkish we were. Lots of aggressive rate hikes last year. The U.S. was really dominating in terms of the dollar. The dollar has since then kind of started to pull back, and you can see that it's declined 7%. The Fed plays into this a little bit as well. The Fed, this expectation of a pivot, this Fed pause has really played a lot into that. And you see that the dollar actually rose a little bit between February and the end of March on this kind of expectation that the Fed was going to get more hawkish. Now they're just getting a sense that post-banking crisis that they're going to be a little bit more dovish again, so that dollar's pulled back more recently. But overall, I think so not only is it what's happening in the U.S., but it's also playing out. The rest of the world is also experiencing quite a bit of inflation, and they're keeping up with the Fed, and in some cases surpassing the Fed in terms of rate hikes. And so that's what's pulling the dollar a little bit lower. That's obviously good for manufacturing exports, and something that we certainly look forward to seeing some additional growth there. So, Jim, you came back on the screen as I was finishing that sentence. I can't hear you though.
3 years into the pandemic, I thought I'd turn the mic on, right? It's an offshoot from your discussion earlier, Chad, with China. With the ramp up of rhetoric around China and Taiwan, what are you seeing as the new key 3 offshore locations that companies are considering investing in or setting up operations?
So we've long been seeing friendshoring to other pockets of Asia, right? Southeast Asia, right? You've seen a lot of investment in Thailand and Malaysia and other pockets of Southeast Asia. We've seen that kind of trend play itself out really over the last 5 to 10 years. You're starting to see a little bit more of increase in India. I think India has definitely benefited from some of that offshoring from China as companies are looking to diversify, right? I think a lot of companies were spooked by the shutdowns, the zero COVID shutdowns last year. They were spooked by the supply chain issues that have happened in general. And again, that makes the US a little bit more attractive. And so outside of the Asian element, I think that North America looks attractive, right? You're seeing a lot of investment flowing into Mexico. I've heard that it's hard to get facilities in Mexico right now just because there's so much nearshoring that's happening there. But also to the chart that I showed you earlier, the U.S. is also coming out pretty nicely in that conversation as well. I think companies are looking at the U.S. in ways that they might not have looked even a year or two ago, right? And so I think those are the 3 buckets I would put, Jim. Certainly, you're seeing Asia, right, including India, which is faring really well, but also North America.
Thank you.
Okay. So let's turn to the employment because this is obviously the bright spot in the economy. We see we've added more than 1 million workers so far through the first 3 months of this year. Yes, that slowed down from where we had seen in January and February, but still 236,000 workers added in 1 month is pretty solid, right? And so this, if you're Jay Powell looking at this, you're saying, hey, the labor market still is pretty tight, and indeed. When you look at the unemployment rate, it's 3.5% again, right? So we did get down to 3.4% in January, which was the lowest since May 1969. So we're still hovering around those 50-plus year lows. So this is what we economists call full employment, right? And so again, very tight labor market. And I do expect this number will continue to move a little bit more north, right? So likely get to over 4% by the middle to 3rd quarter of this year. Probably getting up to 4.5. Probably I think 4.5 is the most we'll get by the end of the year. Probably more like 4 to 4.5. So that shows you that I do expect to see some more cooling in the labor market. But again, juxtapose that sentence, right? I've just told you we might get 4, maybe 4.5% unemployment later this year, with the notion that we're going into a recession on the other hand, right? Go back to the last, you see the pandemic, just ignore the pandemic. Go back to the Great Recession, right, in 2009 and 8, 9, and 10, and you can see that we peaked out at 10, right? So there's a huge disconnect there by saying that I expect the unemployment rate to go north of 4, with another conversation saying we're going into recession. And to the extent we get into a soft landing scenario, I think the labor market is what could either keep us out of a recession or at least make that recession, whatever recession we have, a little bit more mild. We have had some good news on the labor force participation front. That number has moved, inched up a little bit over the last 4 months. We're still below pre-pandemic levels. You probably aren't going to get back to pre-pandemic levels. You see this overall trend line is one that was declining anyway. One of the more affected groups here is people over 55. We've seen a lot of accelerated retirements. Childcare continues to be an issue for a lot of our members. I hear about that all the time. Immigration plays into this conversation, right? To the extent that we're upside down in our birth rates, immigration could fill in some of those gaps, and it's just not filling in to the degree it might have, say, 5 or 6 years ago. And there's just a lot of folks who've just moved to the sidelines for various reasons. But the good news is the labor force participation rate has been edging a little higher, and that certainly is good news, particularly if you're looking for some relief on the wage front. Now, for manufacturing, we had a really great 2021 and 2022. Last year alone, we added more workers than we had in any year since 1994. But this year so far, you've seen quite a bit of cooling, right? And so you can see in February and March, manufacturing employment stalled. We lost 1,000 workers in each of those 2 months. The good news there is, to the extent, go back to my earlier comment, to the extent you're pulling back from a strong base. The good news is that we were just shy of 13 million workers in January, right? So we haven't kind of crossed that 13 million mark, but even the notion that we would get back to 13 million workers, I think, was unheard of a few months ago, a few years ago. So this is certainly a nice sign that, again, manufacturers are adding to their workforce in general. They had been, and hopefully we'll get back to doing that once we kind of get past some of the uncertainties that we're seeing more recently. And the other kind of piece to that is that job openings, while they've cooled a little bit, so they moved under 700,000 really for the first time in a year and a half. It's still a pretty elevated level of job openings. So we're still posting a lot of jobs out there, lots of churn in the labor market. So, again, you've seen quits pull back from their all-time highs. But interestingly, in the most recent JOLTS data, the job openings and labor turnover survey data, quits actually increased in February, right? So you're still seeing quite a bit of churn out there in the labor market. And again, if you're quitting your job, it probably means that there's another job posting waiting out there. So this is a bit of a vicious cycle. I think manufacturers are hoping that the level of churn kind of slows down a little bit, so that, again, you can find workers when you need them, and hopefully that will relieve some wage pressures that are out there. The challenge, though, for all of that is that we still have an environment where there are more job openings than people who are actively looking for work, right? So you did see overall in the larger economy, 9.9 million job openings in February. That's the first time we've been below 10 for again, a year and a half, but still pretty elevated levels of job openings. And there's only 5.6 million unemployed Americans, right? So we're still, that gap is still pretty significant. And it's the reason why this is the number one issue in our survey, is that everyone is chasing after the same workers, right? Everyone is having this problem, right? And you know that by going to pretty much any restaurant, bar, hotel, and you see the lack of service there. You see signing bonuses along the roads. You see wages. You can go to McDonald's or whatever and earn 15, 16, 17 bucks an hour. I mean, the wages have just gone up pretty significantly, again, as we're kind of all chasing the same workers. In manufacturing, we now pay almost 26 bucks an hour. So it's just shy of 26 bucks an hour is the average hourly earnings for production workers. That's up 4.9%. Sorry, I think it's 4.7% in the most recent data. It had been up 5.9% this time last year, which was a 40-year high. So I'm expecting that number to cool off a little bit, but it'll probably cool off to probably 3.5 to 4 is where I kind of see that number moving to. Still a pretty solid wage growth overall. And again, the challenge there is that everyone is really raising wages pretty significantly. And our members have told me that many of them have felt like they had to raise wages several times over the last couple of years just to stay competitive locally with all the other competitors that are looking for some of those workers. The other challenge is that, as impressive as 4.7% is, and it still is an impressive number, consumer prices are going up by more than that. So that's my kind of segue to talk about inflation. Now, we will be getting more inflation data in the next 2 days. We're going to get consumer price index tomorrow, the producer price index on Thursday. So these numbers are going to be watched very closely. So I'm going to go through 3 charts here. They're all very similar. This is the personal consumption expenditures deflator, basically the price index for personal spending. It's the preferred measure of inflation from the Fed, so that's why I'm going to start with it. But I'm also going to go through the producer price index and the consumer price index. Again, we're going to be getting March readings for both of those in the next couple of days. So some good news and bad news here. The good news. You've seen overall inflationary pressures moderate. I expect we're going to continue to see moderation when we get the data for March in the next couple of days. This is a year-over-year number, right? Certainly part of that has been helped by the fact that energy costs have come down a bit. So that has helped that overall conversation. But the other part of that story is math, right? So where I kind of expect these numbers to go is, as you continue to move throughout the course of the coming months, and we have much more favorable comparison months, right? So kind of my poster child for this is June. So once we get to June of this year, And we're comparing inflation this year with inflation last year when we had record high gas prices. You're going to see these numbers fall pretty dramatically. And so given the change in just the better comparison months, we're going to see those headline numbers come down pretty sharply, I think, over the coming months. So that's good news, right? And so that moderation, you're seeing that play itself out pretty more dramatically in the producer price index, but you see that kind of across the board in all three of these measures. The bad news here, if you're looking for bad news, is that these numbers are still staying pretty elevated, right? And on a month-over-month basis, you're still seeing quite high levels of inflation, right? And so kind of my chart I'll look at here mostly is the consumer price index. Again, a reading we're getting tomorrow. You're still seeing pretty high levels of rents. Transportation services are going up by a lot. If you don't believe me, try booking your flight and hotel for this summer and see how expensive it is. Food costs are going up by a lot. And I mentioned earlier, wage growth is still going to stay pretty solid. So that is why the Fed continues to be spooked by kind of these still pretty elevated levels of inflation. It's why the Fed, despite a banking crisis, raised rates by 25 basis points at their last meeting. It's why they likely will still raise by another 25 basis points at either the next meeting or the meeting after that, and before they hit the pause button, right? And so there's still quite a bit of worry out there. On the Fed part, the reality is that, if you go back to the beginning of 2022, the Fed funds rate was effectively 0. Today, it's the upper bound is 5%, right? So we've gone up almost, 500 basis points in a very short period of time. And so there's a lot of implications of that, right? You're seeing some slowing in the housing market. You're seeing some weakening in retail sales and other pockets of the economy because monetary policy has very long lags. And so that is a challenge. I'll quickly address the banking crisis and then we'll go to the outlook. The banking crisis is one, I think the bigger, hopefully it looks like we have moved on a little bit from some of the panic that we had 2 or 3 weeks ago. But I think the real worry there for manufacturers as it relates to the banking crisis is what does that mean moving forward, right? A lot of manufacturers depended on those small and medium-sized banks for credit. Now I suspect you're going to see a lot more regulation on some of those banks, which means they're going to have to keep a lot more on reserve to kind of hedge themselves against, run on the banks. And that will likely lead to some reduced credit moving forward. So I think that's the thing to watch kind of as a spill off of what's happened in the last few weeks I'm expecting much more regulation. And so what is the impact of that on manufacturers, particularly small and medium-sized manufacturers moving forward? So the outlook. So we probably grew around 2% in the first quarter. So this is the quarter we just came out of. I've seen numbers all across the board for this. I've seen numbers as high as 2.5 or so, and numbers as low as 1.5. That's not why I'm 2. I had 2 up there before. But so I still think we're probably in that 2-ish range for GDP for the first quarter. So again, a little bit more resilience in the quarter that we just ended, really building on kind of the solid second half of last year. Yes, we did decline in the first half of 2022, but we did bounce back from that. And you see some resilience in the economy over the last 3 quarters. This probably was a high watermark. I expect to see a little bit weaker growth for the rest of this year. One of those could be negative. I don't have a negative right now. This is essentially a soft landing scenario, but we'll see kind of where the data play out over the coming weeks and months. And if you're gonna see kind of that risk of a mild recession, it probably would be in the second, third, or fourth quarter of this year. And just to kind of flash forward a little bit to the overall upside and downside risks. I did put the banking crisis up here as a downside risk to kind of start at the bottom of that part of it. But I think the bigger risk to the economy has to continue to be the Fed. Are they overdoing it? Do they need to keep raising rates to kind of bring inflation out of the system? That's kind of the conversation, right? Of again, the long lags. We don't know the full extent of the damage from the rates hikes that they did at the end of last year, and yet they're continuing to raise rates. Are they again overdoing it? So that's a huge risk. We still have the risk of the Ukrainian war and what that means for especially Europe, but also the global economy. Inventory levels is something that I have been watching. I kind of hinted about that earlier. They were a bigger deal on the retail side, but again, you were hearing some increased inventory levels for manufacturers as well. And then there's this notion that we that we are talking ourselves into a recession, right? So I think all those are the biggest downside risks. On the upside risk, right, and I said this earlier, to the extent we were able to avoid a recession, right, everything hinges on the labor market, right? As long as people still have jobs, as long as they still have solid wage growth and they still go out and spend, you're going to see some resilience in the economy. Yes, we've seen a lot of layoffs in the tech side, especially, but those folks, I suspect, aren't being unemployed very long, right? And so, given how tight the labor market is, at least for right now, you're still seeing quite a bit of tightness out there. Watch that number, right? I think if we were to go to 4.5 or even 5% unemployment by the end of this year or beginning of next year, that probably means we slipped into a mild recession, in my view. As long as it stays in that lower 4 range, we probably maybe we eked out a little bit of growth, which I think that's the thing to watch. The other upside risks, tailwinds from all that increased spending we're seeing, right? You mentioned semiconductors earlier, the Chips and Science Act, the Inflation Reduction Act, or infrastructure spending, lots of dollars moving out the door right now. All that reshoring is going to have an impact, and so that's will provide some tailwinds to some headwinds we might be seeing from some of the other pockets of the economy. And then, I moved the global economy from the downside risk to the upside risks. It doesn't mean the global economy is growing fast. It's still growing weaker than we would like, but I do think that China and the global economy are going to eke out a little bit better growth than we would have expected, say, 3 or 4 months ago. And so I moved them to the upside risk category. So the last chart I'll go through, I'm expecting manufacturing production to decline about 1% this year, but rebound as you get towards the end of this year and moving into next year and growing around 2% in 2024. So with that, I'll leave my contact information up there for a few minutes, and then we can take other questions, Jim.
Thanks, Chad. Yeah, they've been piling up, and I know you were leaving some time, opted to go through them at the end. So with the automotive sector, which is a big piece of our economy, there seems to be a lot of focus on batteries for electric vehicles. Where do you see that going?
Yeah. So the auto sector has just been whipsawed, as you know, over the last couple of years, right? I mean, you had, obviously you had the pandemic, you had the supply chain issues and chip shortage, and now you have this really just complete transformation of the auto sector really over the next decade, right? As it moves from gas combustion engines to electric vehicles or some combination thereof, right? Maybe some of that's hybrid as well. And so that transition is one that has some real consequences to it, right? So you're seeing a lot of investment being placed in battery production, in the switch over from gas combustion engines to EVs. You have certain markets around the country, right? California is an example, but also in Europe and other places where, you know, they're after 2030 or 2035, you can't sell gas combustion engines, right? And so that switchover is happening. So a lot of investment is being made in that transition. That changes in many ways the type of worker that the sector needs, right? If you're thinking about I have an electric vehicle, right? I feel like I'm driving an iPhone at times, right? And the reality is, I am in many ways, right? So you're looking for sometimes a different. I mean, on the shop floor, the workers are very similar, but as it relates to design, as it relates to a lot of the other kind of facets of manufacturing, we're competing. You know, GM is competing with Silicon Valley for talent now, right? And so that changes a little bit of the structure of the game in terms of where we go as a sector. Certainly, as it relates to chips, as it relates to batteries, as it relates to anything in the batteries. You know, as I mentioned earlier, the companies have become much smarter with their supply chains in terms of really honing in on key suppliers, right? Maybe also kind of reducing some redundancies there. So using data, using digitization, using smarter procurement techniques, I think is all happening that sector. The only other comment I'll make about autos, because it's certainly one that's worth noting, is that if you wanted to buy a car over the last couple of years, you probably weren't able to buy one, right? There wasn't a lot of inventory out there. There's still not a lot of inventory, although it's improving. And so we saw a huge run up in prices, not just for new cars, but also for used cars, because if you couldn't buy a new, you bought a used. And so you've started to see used car prices kind of come back to earth a little bit. But even with that, inventories are still pretty tight. And there's still a lot of pent-up demand out there for autos, despite higher interest rates, despite uncertainty in the economy. There's still a lot of folks who want to buy a car. So you're going to see a little bit the auto sector being a little bit more of an outlier in terms of seeing some underlying demand strength. Because again, if you wanted to buy a car and couldn't, you now can.
And Chad, you'll go with the audience to get a discount off sticker going forward. We could use your help on that front.
We all could. We all, you're starting to see some discounting there, right? For a while, as you know, there was no discounting involved in buying a car. So you're starting to see some incentives come back in the market after a couple of years where there wasn't any at all.
Okay. Next question. Next two questions are kind of related, but how many new jobs last month were in manufacturing? I think your slide was $1,000, or excuse me, 1,000 jobs.
So yeah, we lost 1,000. Yeah, we lost 1,000 workers last month. So that was in March. Overall, as you saw earlier, the economy added 236, I think, thousand. So we were unfortunately we were a drag on that overall figure. I would say we essentially were unchanged. So none of that job growth came from manufacturing. Although there were pockets of the manufacturing sector that did see growth, right? So, and I can't think of them right now, but I did write about them in the Monday report, Jim. So I'll have to go back and look at that, or you can look at it on Twitter and you can see what I wrote. But okay. So that answers that question.
And is the disconnect between people looking and job openings because of skill sets?
Yeah, I think a lot of that has to do with skill sets. It also has to do with perceptions, right? I talk to a lot of manufacturers who just simply want people to come in the door and apply for a job, right? And they don't think of them, right? There's a lot of biases out there about what manufacturing is and what it isn't, right? People might perceive it to be dark, dirty, and dangerous, which it's not, or maybe their grandparent lost a job at some point. And so there's these perceptions out there about manufacturing that we've got to turn around a little bit. Certainly Manufacturing Day and some of the initiatives that we are doing to kind of help change perceptions is hopefully helping that. I think as the sector becomes much more technologically advanced, I think that also helps change that conversation. So yes, it's a bit of a skill, right? But it's also perceptions. And it's also just the notion that it's just a tight labor market right now. So for entry-level talent, the reality is we are competing with a lot of non-traditional players. We're competing with Amazon and the service sector and with, a lot of places I don't think we thought we competed against before, right? The other challenge, there's not enough engineers, right? So we need to accentuate, STEM fields in the career in the industry, as well as the trades, right? There's not enough welders or maintenance technicians. I spoke to a manufacturer yesterday that has been looking for the last year and a half for a maintenance technician and can't get one, right? And so part of that mismatch is that it's just a very tight labor market and everyone is looking for the same workers in many ways.
Yeah, thank you. You spoke about investment in technology, Chad. Has AI, artificial intelligence, made any significant changes to or influence buying patterns with companies, especially on materials?
I think that AI is one of those emerging technologies that's going to have a huge impact. You're already starting to see some implementation of AI on the shop floor where, perhaps it's following kind of in real time the production process and hopefully can identify where there are some, errors that, could be corrected or some ways to try to improve the overall performance. So I think AI is going to just have a transformative function to the way we innovate products, the overall operation plays out, the way we sell products, right? So there's going to be a lot of change there that kind of comes from that. I think we've all been playing around with ChatGPT. I don't know if you have, Jim, but and you see just how cool the technology is. But I think if spin that out 2 or 3 years, and I think that that's going to have some implications, not just for manufacturing, but for the larger workforce. Does not mean we don't need people. So I want to dispel that notion. It just simply means that those workers that we will have some new tools at their disposal that will hopefully make them more productive.
Thanks, Chad. And that covers another question, which was, have you heard of manufacturers looking at AI and automation for engineering and product development solutions?
And I haven't personally. I know that we have the Manufacturing Leadership Council that's kind of part of the NAM. They really have done a lot in this space. I think they have a survey in the field right now. So I'll put a pin in that and say maybe look for that survey when it comes out in a couple weeks. My sense in talking to manufacturers is that they're doing it and using it, but there's probably more precision to that answer that probably some of that survey will kind of help to address.
Okay. A strategic question from the audience. How has rising interest rates changed strategic planning? Do you see expansions deferred or abandoned as a result of that?
It no doubt has. I mean, if you're doing your internal rate of return, right? We all took finance classes at one point in our life. Higher interest rates are going to mean some projects don't happen, right? And so we know that that's going to be the case. Yet at the same time, it's interesting how little I hear about that. It's one of those issues that if I bring it up, people will say, oh yeah, that means we're going to be doing fewer projects. But more common is the notion that, hey, the Fed hasn't done enough. They should have started raising rates sooner, right? And so I tend to hear more of that more policy argument that, the Fed is behind the curve and they should, there's lots of worries about inflation there that aren't being addressed.
Okay, we also received just a comment. It would be great to have Chad update the presentation with the new data that is coming out. You hinted at a few major indices that are getting spread out later this week into the balance of April. So
that's a great question, and I will send you a revised version after the next couple days.
Okay.
Well, actually, after Friday, because Friday we get industrial production, so maybe on Friday I'll send you a newer version, Jim.
That's great. Any other questions from our audience? We spoke about favorable sectors within the manufacturing world over the last 6 months. Any particular reason for that? In other words, sectors that have outperformed, let's say, within the industry.
I mean, you're certainly seeing, obviously, the auto sector's rebounding from the chip crisis, and so that kind of rises to the top. But so has aerospace, quite frankly, right? Yeah, everyone's flying. That sector's in a much healthier state than it was before, so that certainly is a bright spot. Chemicals and pharmaceuticals have been a bright spot as well, for obvious reasons for pharmaceuticals. But on the chemical side, we've seen reshoring on the chemical side for a number of years because of natural gas prices. So that probably is a trend that's going to continue to accelerate. So those are some of the bright spots. I think anything involved in construction is going to be a bright spot this year because of the infrastructure bill and all the spending that's happening out there. Now that's mitigated somewhat by slowing global growth and exports, but at least the infrastructure bill will help mitigate some, be a little bit of a tailwind there.
Okay. That wraps up the questions as I see it. Alexis, I don't see any others coming through, but pretty active audience. Thank you for your input on that. And just from an editorial perspective, the NAM and a number of statewide organizations represent you, the manufacturers. And if you see a bill or legislation that's going to put a hurt on your business, please reach out to the NAM, because nothing affects people more down in Washington, D.C. than seeing good old-fashioned American companies putting their disagreement or to inform our legislators and other branches of the government what a hurt it would put on this sector. And we're starting to see that. There's a grassroots movement on trying to, repeal the R&D tax treatment, and that's been pretty successful. But it's a very compelling argument and position when you have Main Street and, as I said, American companies educating our elected officials as to the far-reaching implications of legislation, stuff that they may not be aware of when they're drafting it as well.
I agree with that wholeheartedly, Jim. We always want to hear from manufacturers. Sometimes we don't know about things until you tell us, right? But definitely legislators want to hear. They want to hear from actual manufacturers before they want to hear from me, right? And so, especially if you're in their district, and so definitely think about that. And if you have a problem, you want to make sure you let them know. and us.
Great. Well, thank you so much, Chad, for your presentation today. Thank you to the audience for joining us. Good crowd, great questions, and we'll follow up with a couple pieces of information and presentations in due course. We'll send those out via email. And obviously, if any of your colleagues couldn't join us today, by all means, we're going to have this presentation loaded up on our website later today. Okay. Thank you so much. Take care of yourself. And again, Chad, thank you so much.
Thank you.
Bye, everybody.